Session 41, subject financial management, then 5th sem BCom students. Now today we'll discuss about the topic about optimum capital structure. Now what is this optimum capital structure? Optimum capital structure will play a vital role in terms of cost of capital. Effective combination of debt and equity should try to minimize the overall cost. Thereby, the value of the company can increase. However, many conventional theories prove that the change in the leverage may reduce the cost for a period of time, but it may not be consistent due to the passage of time, and the cost may go up due to inflation. Hence, there is need for companies to focus on optimum capital structure and to have an optimum overall cost of the capital for the consistency in the growth of the company. Now, the combination of debt and equity that leads to the maximization of the value of the firm is called optimum capital structure. Just once again, the combination of debt and equity that leads to the maximization of the value of the firm is called optimum capital structure. It maximizes the wealth of the owners and minimizes the cost of the capital. So, every firm should definitely try to achieve optimum capital structure. Now, what is the need of an hour for the companies to have efficient leverage through which effective cost of capital can be maintained? So, this is a need. Today's need we have that company has to maintain efficient leverages. If not, it cannot maintain its profits in the organization. This will have positive impact on the profitability, which is one of the primary goal of the management. Firms should analyze a number of factors or establish an optimum capital structure. The capital structure may change, but at any given time, management should have a specific capital structure in mind. If the debt ratio is below the target level, expansion of capital structure should be raised by issuing debt. Whereas, if the debt ratio is above the target, equity should be issued. Now, this is meant by capital structure. Now, we will talk about what are the qualities of the capital structure. Now, the qualities of the capital structure we'll go on discussing one by one. First quality is simplicity. Initially, the capital structure should be raised from ordinary and preference shares. Only in case of crisis, debt funds should be used. The capital structure should be simple. Flexibility. The capital structure should be flexible enough so that whenever required, it can be increased or decreased depending on the need at that moment. Next, minimum cost of capital. The funds acquired from different sources have different cost associated with it. By acquiring funds at the low cost, it can invest in new projects and thereby earn huge projects. Then we have liquidity. The company may have many commitments for making payments like interest, dividend, wages, premium, etc. This affects the liquidity of them. If the provisions are maintained to retain adequate liquidity separately, it will be beneficial to company as it will not affect capital. Next, it is maximum return. The borrowed funds increases the level of risk because interest of such funds has to be paid before making payments to the shareholders. If the track record is good, it can avail more funds in the future if needed. Then it is legal requirement. It should determine that the debt to equity ratio as preferred by the capital issue control. Next, we have major capital structure planning as we have discussed earlier slide also. So, this is some of the requirements of your qualities of your optimum max capital structure. Then, if the return on investment is higher than the fixed cost of funds, the company should refer to raise funds having a fixed cost, such as debentures, loans and preference share capital. It will increase earnings per share and market value of the firm. Thus, a company should use maximum possible use of leverage. When the debt is used as a source of finance, the firm saves a considerable amount in the payment of tax as interest is allowed as a deductible expenses in computation of tax. Hence, the effective cost of debt is reduced, called tax leverage. A company should therefore take advantage of tax leverage. So, this is something which are concerned to the capital structure. The other thing is, one more point we have to refer is the firm should avoid undue financial risk attached with the use of increased debt financing. If the shareholders pursue high risk in using further debt capital, it would reduce the market price of shares. Then the capital share structure should be